Monday morning, November 28th, the Monday after Thanksgiving. Hope everybody had a wonderful holiday and back and ready for the deep dive. You know, we start out the week with the deep dive every week, talking about what's most important in real estate. You know, this week, if you saw the message, we're going to be talking about headlines. You know, a lot of talk about real estate in the news, and we've always said headlines do more to terrify than they do to clarify what's actually happening. We're going to kind of take a deeper dive into some of those headlines, talking about debt, consumer debt, real estate debt, being talked a lot about in the world right now. And I expect that it will continue to be talked about as we go through the winter and certainly continue to navigate this market. So as you join this morning, always let us know where you're watching from so that we can get this started. People from all over the country watch the deep dive and get their week started off this way, talking about these topics in real estate. So if you're a KCM member, don't forget you can always download these slides and use them if maybe you're out talking with someone or somebody asks a question. That's why we do the deep dive, so that you're educated and you're able to deliver the best information possible to those that you serve. So with that as kind of a backdrop, I'm going to go in here now. See it, Jennifer, see you there in Texas. Michelle in Virginia Beach. We're just up the road in Richmond. So great to see you. Fernando and Tamara, great to see you. Scott, see you there. Travis in Colorado Springs, Stacy in LA. So many folks all over the country joining and watching the deep dive this morning. Grateful to have you on. And grateful to get our week started this week. So I'm going to share my slides and get us started as we talk about these headlines. You know, I mentioned, if you weren't on just a minute ago, you know, the headlines always do more to terrify than they do to clarify. And so let's get to it and talk about these. So the first one I have here is a tweet that's from Diana Olnick. She said, homeowners have lost 1.5 trillion in equity since May as home prices drop. And this is referencing a Black Knight study. You know, we use Black Knight a lot at Keeping Current Matters, just as a resource that has phenomenal information, a lot of mortgage information, a lot of, price and equity information here. And, what this article basically says is, since July, the median home price in this country has dropped just over $11,500, $11,560 to be exact. That is translated into 1.5 trillion in equity that's been lost since the middle of this year, technically since July. Now, what I want to do is I want to put this into perspective for you, because that's accurate. That's an accurate headline. But if somebody were to read that, it sort of pretends this, drop in prices that's going to lead to this cataclysmic event in housing, and just, again, simply not true. So if we put this into perspective, this is a look graphically at what this means. This is a drop in the tappable equity to $10.3 trillion, to where it sits right now in the third quarter, as of the third quarter of this year. Now, I want to kind of break this down for just a minute. Tappable equity, if you remember, is the amount of equity a homeowner can access before they hit 80% LTV, or 80% of the value of the home. So if you have a $100,000 home, tappable equity gets you up to $80,000. And if you put that into perspective, that's still $400 million above where we were this time last year. But here's what's even more important. If you look at 2019 here, in 2019, we were just over $6 trillion in tappable equity. And we've shot up, at the height, that was over $11 trillion in the second quarter of this year. Now, just over $10 trillion. So significant equity in homes across the country. And I don't think a tweet like that from Diana gives the full picture of just how strong equity is in this country. We talked for, many, many months post-pandemic that equity was the shining star of the real estate market coming out of the last couple of years. If you continue on with this, just about equity, First American said this: homeowners have very high levels of tappable equity today, providing a cushion to withstand a potential price decline. but also preventing housing distress from turning into a foreclosure. The result will likely be more of a foreclosure trickle than a tsunami. Now, in just a minute, I'm going to talk about household debt and mortgage debt as relates to headlines in that, but no doubt strong equity across the country is helping homeowners navigate this market. And many of those have strong equity. They have a very low interest rate. According to FHFA, 92% of the mortgages in this country are below 5%. And you're seeing a lot of people say, we're going to hang here, we're not going to move. And that's, maybe preventing some of the inventory from coming to market right now, no doubt across the country, but very, very strong levels of equity in homes all over the country. Let's sort of transition this to debt, because that's where the conversation generally there goes. And household debt is certainly a topic as inflation is bearing down upon everyone. A CNBC article, household debt soars at the fastest pace in 15 years as credit card use surges, according to the Fed. So if you haven't seen a headline like that, expect to see those, expect to see more of those as the rapid rise in people accessing credit cards, using that maybe to even bridge the gap in some of their lifestyle right now with high inflation. Now, if we put this into perspective, that's always what I want to try to do on the deep dive, and what we try to do at Keeping Current Matters is give you perspective on where household debt sits and what that means. So if we go back to credit card balances right now, according to the Fed, this is coming from the same information, credit card balances are right at where they were in 2019. This is a look at 2019 to the third quarter of this year. Now, the rapid rise has certainly come on very quickly, and there's a reason for that. As we went through 2020 and 2021, stimulus money coming into people's pockets, what did we see back then? We saw balances in savings accounts rise, and we saw less usage of credit cards. So it makes a lot of sense that we would be on the rise right now, and certainly that due to higher inflation being a fact as well. But the perspective on this is we're right near where we were in 2019 levels. So I think, as people start to see, well, credit card balances are rising, people are losing equity in their homes, going back to the earlier headline that we used, starts to create fear. On the same blog that released this information, the New York Fed, the Liberty Street Economics blog, they said this: though delinquency rates, they're talking about credit card delinquency rates, are rising, they remain low by historical standards and suggest consumers are managing their finances through the period of increasing prices. So certainly credit card debt is on the rise, but very comparable in the range of where it was pre-pandemic, and we want to keep that in mind. The other question that always comes up is mortgage debt. Okay, where is that at across the country? Because that brings on the concern of, can people afford to pay their mortgages, and how's that going to play out? I mentioned, the FHFA stat that many people across the country have a very affordable mortgage, and certainly as the rates have risen, they've said, hey, we're good. We're not going to refund. We're not going to move out of this home with a low mortgage rate. Now, life events certainly will cause people to move, but a lot of people will make a decision not to based upon that mortgage rate that they have. But if we look at the debt to income ratio of mortgages across the country, we sit at a point lower than we've been, going all the way back to the 80s. And this is the household debt service ratio for mortgage as a percentage of disposable income. So you see this, you look across the country, the average of where that debt service ratio is well below where it was during the housing bubble, well below even the 80s and 90s in this country. So, mortgage debt is not an issue right now that we need to look at and say, okay, with strong equity, with this low household debt service ratio, we can have a perspective on that as we see headlines, as we see these things that are intended to draw people in, sort of make them worry about where debt is at in this country. If we even think about, delinquencies relative to mortgage, they're low as well. And I'll bring in a quote here from the MBA. For the second quarter in a row, the mortgage delinquency rate fell to its lowest level since the MBA survey began in 1979. Declining to 3.45%, and foreclosure starts and loans in the process of foreclosure also dropped in the third quarter, levels further below their historical averages. So not seeing this flood of delinquencies, which is a leading indicator of foreclosures. Not seeing this flood of foreclosures coming into market. If you look year over year, foreclosures are up, but they're near record lows. This is a look at it right here. So far, as of the third quarter, there have been 88,000 new foreclosures in this country. If you keep on that trend, that equals, call it 120, 125 new foreclosures in this country this year. To put that in perspective, you can see there in 2019, there were 278,000 foreclosures in this country. So certainly more than 2020, more than 2021, because there was a moratorium on foreclosures. We're seeing more this year, but nowhere near something that would be, sound the alarm, and we've got issues coming right now. So staying on top of these headlines, staying on top of what's happening with debt, with certainly foreclosures, with equity. That's what we need to do right now. These are topics that no doubt as we go through the next few weeks and people are gathering and different holiday gatherings and with family, these topics will come up, and being armed with the answers is what you need to do. And really, I think as we navigate this market over the next few months, will become increasingly important. To do that, I want to remind you that today is Cyber Monday. It's the last day of our KCM offer for Black Friday and the deal that we've had going on. If you've been thinking about becoming a KCM member, I would encourage you to go ahead and start a free trial. You can do a 90-day trial here and get a deal. If you're a KCM member, you can go in and upgrade as well and get this deal as well. So if you're thinking about doing that, go in and check that out. Jess, in just a minute, find out if we have any questions. But again, if you're thinking about becoming a KCM member, we want you to do that and use this deal to do it. So, Jess, any questions right now that are coming through?
Hi, Dave. I did see just one question so far from Tamara, who said, cool stat from FHFA. Do you have that link or know where they can access that link about the average interest rate for homeowners?
We have that. Tamara, you've got my email address. Shoot me an email and I can send that to you. But it can give you the layout of mortgages. And even if people would like it, I could add it to this deck where you could download it as a KCM member.
Awesome. Thank you, Dave. And I just wanted to point out one more comment from Scott, who said, all-time great deep dives last week and this week. Way to go, team. So thank you, Dave.
Thanks, Scott. Well, listen, we're grateful for everybody that joins the deep dive to start their week, being the educated agent. We've always said the educated agent wins, and certainly in this market, I believe that is true. So hope you enjoy this week. Have a great week, and we'll see you back again next Monday. Take care.